Welcome, everybody. Thanks for joining us today, wherever you might be. It's good to have you with us here for a little while today. We're excited to share some information with you here today. We got a number of people that are going to be participating in today's webinar. So I'll introduce them here in just a minute. But again, just want to thank you all for taking time out of your day to spend it with us. It's a snowy day out here in Colorado, and hopefully things are nice wherever you are. But just a couple of housekeeping items. We will be recording this webinar. We will send out a recording to everyone that registered afterwards. So you'll get that sometime in the next couple days. Also, just wanted to remind everyone that this is a CPE eligible webinar. So there will be some poll questions throughout the webinar that you will have to answer in order to get CPE credit. So those of you that are trying to get some CPE here, make sure that you answer those poll questions so that you can get that credit. And then if you have questions throughout the webinar today, go ahead and drop them into the chat in the GoToWebinar app. We'll get those and we can field them if appropriate during the webinar, or we can address them at the end if we have a little bit of time. If we don't have time at the end, then we'll make sure that we follow up and respond to any of those questions that come through. So again, really appreciate your time, everyone. Thanks for joining us, and would just like to make a quick introduction of those that will be presenting on our webinar today. I'll let you guys read that. I think most of you probably know us that are on here today, but if you don't, Richey May is proud to have served the mortgage industry for many years as a firm across audit, tax, and advisory services. Served many great clients around the country, and it's our privilege and honor to do so. So thank you to our clients that are on today. Thank you to our friends and others in the industry that are here today. We're here to serve you however we can. We know it's challenging right now, so reach out if there's anything we can do to help. So with that, I'll introduce today's presenters. So we have Jennifer Hanna, who will be speaking to us today about some audit and financial statement related matters. And Jennifer leads our mortgage banking audit assurance practice here at the firm. And Molly Manuzak, who leads our business intelligence and data analytics practice, will share some quarterly, some Q3 data and some other insights that have been gleaned from the data that we gather from clients. And then we will wrap up with Seth Sprague, who most of you probably know. And Seth Sprague is the Director of Consulting Services here at the firm, longtime mortgage industry consultant and advisor. And we'll also hear from Michael Nugier, who leads our cybersecurity practice, and Jared Frost, who is the partner in charge of the mortgage banking tax practice here at the firm. So we have a long list of presenters. So without further ado, we're going to jump right in, and I'll hand things over to Jennifer.
All right, so we are going to just talk about a few audit trends that are going to impact this current year-end audit engagement planning. A couple of things. First would be going concern questionnaire and potential analysis. We touched on this a little bit during the last trend series webinar. Today, I just wanted to talk through some really quick, easy things that you could hopefully work with your owners of the company to make sure that your balance sheet looks as healthy as possible before year end for the readers of the financial statements. Another thing is just a quick check-in on your lease implementation plans. If you are using a third-party software provider, is the documentation and everything updated? Is everything implemented and input into the system? Have you kind of tested it, found where to pull the reporting? little things like that, please don't hesitate to reach out to Richey May on anything related to leases. We have a group of people that have expertise in that area that can assist in questions, how to put it into the system, a variety of different things that you may need. If you're planning on doing that in Excel, there are a number of required disclosures that are going to need to be pulled from that Excel file. So what we're going to do with that is do little videos for people on specifically what is needed for the footnote disclosures, so you have a clear path of how you pull that information and what's going to be needed for your financial statement disclosures. So we'll make sure that you're all ready before year end and before the audit starts for that. Big thing, there have been a lot more questions, I think, because of the difficulties that the mortgage industry is facing right now with readers of the financial statements, warehouse lines, investors, some of the agencies a bit more scrutiny to clients' balance sheets. So we are really recommending strongly, if you are able to put in a capital contribution, if you need it, before year end, just to make your balance sheet, you know, if you are struggling maybe a little bit with your cash balance, if there was a way to put in a contribution and don't distribute that after year end, keep it in that in your company to make sure, you know, your balance sheet looks so healthy at year end for the readers of the statements, and keep that contribution within the company. Don't take it out right after year end. I think that would be a good idea to help with the readers of the financial statements and kind of the scrutiny that some of these statements are undergoing. So Molly, if you want to flip to the next slide, some of the quick and easy things that we're looking at is just simple cash. How much cash, how much escrow cash do you have, and then what are your current liabilities? This is not a end all be all. This is just a really quick analysis that we're doing at interim to see, okay, you have $850,000 of cash, you have $545,000 of current liabilities. Here's your current operating line of credit. Do you have sufficient funds in your operating line of credit to draw down and kind of support your company if you continue to have monthly losses? Adding in current liabilities. One big thing is loan loss reserve. We look at that loan loss reserve balance as like a current liability. So do you have sufficient funds to cover that loan loss reserve? And this doesn't mean it's an end all be all. It's just a quick and dirty analysis of where you are. Can you pay your current liabilities? There's other steps. How much capital can you have contributed into your company? Are you selling your MSR portfolio that's going to, you know, wipe off a lot of these liabilities? Are you projecting out trends? Have you hired a new branch? There's a plethora of different things that can kind of be taken into consideration when we look at this. But quick and dirty for year end, just making sure readers of the financial statements see that you have sufficient funds to cover, you know, AP, any liability that might come due fairly shortly. And with that, please don't hesitate to reach out if you have any questions whatsoever. We'd be happy to talk through any of this stuff with you. With that being said, I'm going to go to a poll question. This will be the poll question, first poll question. Please respond to it if you want CPE. So will you be done with ASC 842 lease implementation before year end? And we'll give you a little bit of time to respond to that, and Gabrielle will shut the poll down when she sees the bulk of responses coming in. All right, and from there, looks like most people are ready. That's really good news. From here, we're going to turn it over to Molly, who's going to go through our Richey May Select data and let you know what this last quarter looks like. So thank you.
Hi, everybody. Thank you for being here today. So for those of you who might not know, my team here at Richey May is responsible for various analytics and benchmark offerings. That includes Richey May Select, which is what I'll be covering today. So for anybody who's not familiar with our Select program, it's a quarterly financial benchmarking program that we started over 10 years ago. So we currently have about 85 IMBs participating. They each submit their financials quarterly, and then they can see that in comparison to their peer groups. So peer groups are broken out by size and channel mix. Today we're going to be going over Q3 results, including origination trends over the quarter and key financial metrics. So at a high level, we saw decreased production in Q3 on average. We also saw a large decline in net production income and gain on sale. And then we did see cost to originate on a per loan basis increase again this past quarter. And one thing I want to kind of reiterate for those of you who haven't been on these webinars before is we're looking at the entire Richey May Select population. So if you're following along trying to compare, just keep in mind that, again, we have companies of all, shapes, sizes, channel mixes, etc. So here we're really meant to look at overall trends, averages over time. So I'm going to go ahead and dive into origination trends first. So here on your screen, you'll see we're looking at average production over time. So we're looking back all the way to 2017. Definitely not a surprise to anybody, but volume was down quarter over quarter on average. That's definitely expected given, the increase in rates that we've seen throughout this year. Typically, Q3 is fairly strong from a seasonality perspective, but Q3 of this year we're down, again, on average, about 18% from Q2. If we look at Q3 of last year, we're down about 40% in production year over year. Really kind of looking at this page, the silver lining here is that this number is still relatively high compared to historical norms. The previous high that we saw before 2020 was in Q3 of 2019, and this quarter we're actually slightly above those numbers. So something to definitely keep in mind as we're going through these pages. We did see a decrease across purchase and refi volumes alike. As a percentage of volume, we saw an increase in purchase production and, of course, a decrease in refi. Overall, refi production was only 11% in terms of total production over the quarter on average. That is the lowest refi percentage that we've seen in program history. So that's kind of what production looks like. So I'm going to go ahead and get into the financials a bit more. So on this page, we're looking at two main metrics. So we're looking at net production income compared to GAAP net income. So for anybody who might not be familiar with what this net production income number means, this is really intended to show origination platform profitability. So we're taking that audited financial income statement and we're excluding a number of different items so that we can really show an apples to apples comparison, or more of an apples to apples comparison across peers. So we're excluding a few items. We're excluding anything related to servicing, so income, expenses, etc. We're excluding any unrealized gains or losses from your unfunded lock pipeline, really in order to kind of smooth out the differences that you see quarter to quarter in that unrealized pipeline. We're also excluding loan loss reserves and any outside activity or investments that aren't related to originations. So one thing I'll note is that this quarter in Q3, we did see kind of the gap between the two increase. So net production income overall, on average, is down about 81 basis points from Q2. This is the second quarter this year we've seen negative net production income. We saw a similar drop earlier in the year in Q1. This was largely driven by, of course, those decreases in production that we were just looking at. So we saw an overall decrease in revenue. Costs were actually down slightly, but with the decrease in production, costs in terms of basis points are actually going up. And kind of, another trend that we're seeing here is that staffing continues to be an issue that everybody is grappling with. Lenders are really trying to determine appropriate levels in this market. So the other metric here that we're looking at is that GAAP net income. That is also down from Q2 about 47 basis points from the prior quarter on average. The last time we saw negative net income in the program was at the end of 2018. We really did see very similar trends here between the two. So we saw, overall decreases in revenue and increases in costs. Kind of the big difference is the, all of those exclusions that we're making from the net production income, kind of softened that decrease that we saw in net income. So I'm going to dig into secondary gain on sale, looking at our net production income report. So really, secondary gain on sale here is intended to show realized gains and losses. So we're really excluding any unclosed IRLCs and open hedges. This really does play a large role in that overall NPI number. So again, here we're looking at an average of all select participants. So it includes lenders of, all sizes, channel mixes, and so just another thing to keep in mind. So we did see another decrease this quarter, kind of similar to Q1. So quarter to quarter, on average, secondary gain on sale is down 61 basis points. Comparing that to the peak that we saw in Q4 of 2020, secondary gain on sale is down about 42%. So here I'm including the entire history of the program so that you can really see, those shifts over time. And then you can also see this is the lowest number that we've seen, since the inception of the program in 2012. So kind of similar trends, across the board. So lastly, I'm going to dig into expenses, looking at cost to originate. So here we're looking at total cost to originate on a dollars per loan basis, looking at all expenses related just to originations. So again, we're kind of removing anything related to servicing or those outside investments. We're dividing those expenses by the number of closed loans over the period. So the good news here is that cost per loan is up quarter over quarter, but overall expenses have decreased slightly. Costs are just up on a per loan basis due to that decrease that we saw in production. So overall from Q2, on average, cost to originate is up about $480, just over that $12,000 mark. So as we're looking at this cost per funded loan, we did see an increase in both personnel and operational costs. So on the personnel side, we did see a decrease in sales expenses. This decrease is in both sales and sales support staff related costs. That's likely due to shifts in staffing over the period. And then otherwise in fulfillment and back office, we saw slight increases over the period. On the operations side, those overhead expenses, we did also see an increase. But again, those costs kind of tend to fluctuate a little bit less. Some of them are more fixed. And since we're allocating them to a smaller number of loans, based on that decreased production, costs went up, so we saw an increase here. So it's important kind of as we're looking at these trends to really have some perspective. So when you're comparing to the previous, couple of years, these numbers are really high or really low, depending on the metric. But just keep in mind that the last couple of years were truly record-breaking in many aspects. So it seems we're now more in line with kind of pre-2020 numbers. And so just as you're looking ahead to Q4 and to next year, there are a couple of bright spots. Production is still at that pre-pandemic high level or a little bit above. And then there's also some hope that rates will, flatten out. We've seen a little bit of that activity in recent days. So, just some things to keep in mind looking forward. So I'm going to go ahead and pass things over to Seth. He's going to give you some additional industry trends and kind of what he's seeing across the board.
Thanks, Molly, for that great data, as always, from the Richey May Select database. And I guess as we were going through the prep for some of this, I was told to be more positive and less Dr. Doom. So, hey, we set a number of records in Richey May Select this quarter, so that's good. And to start with some good news, and everyone knows how much I love numbers and how good I am with math. But if you read Yahoo this morning or looked at the Freddie Mac primary mortgage rate survey, which they've kind of tweaked a little bit, mortgage rates had their largest week-over-week drop in mortgage rates in 41 years today. So we went from just above 7 to just above 660 in mortgage rates last week as a result of a good inflation number at 7.7%. So hard to say that is a good number, but it was better than the market expected. So as Molly kind of pointed out, there is some bright lights there on at least on the mortgage rate side, that rates have stopped going up. And I do think as inflation does get perceived to get better under control, we could see the 10-year Treasury to mortgage rates collapse and get back to sort of more of a long-term the long-term trend there. So Molly, I may need you to advance the slides because I don't seem to have the ability to do that today. So if we go, wanted to kind of talk about three things: revenues, expenses, and risks. And as Molly has already laid out, this is some data from some bank information on gain on sale. As I tend to tell people, I don't have any opinion as to what banks are putting into these gain on sale numbers. This is what they're reporting in their financial statements. So when Truist reports less than 1 basis point gain on sale, you should probably read their financial disclosure a little bit more closely and see exactly what they did during the quarter. But consistent with the Richey May Select data, year over year, reported gain on sale for these large banks that are all in the mortgage industry is down 51%. Quarter to quarter, we're down about 6%. So again, the banks, the IMBs, we're all suffering from that loss of revenue. And we go to the next slide. We've got from the origination volume side, again, these are banks. I always want to caution whenever we look at banks here, remember banks participate both in the jumbo space, portfolio arm space, and in many cases, many of these banks are also aggregators out there. So they don't always reflect the same change that you might see from an independent mortgage company that is, primarily creating secondary marketing eligible product. But quarter to quarter down 26% and down 54% year over year. I will highlight the following. If you go back to Q3 2019, and again, this is volume, this is UPB, unpaid principal balance. There's 165 billion that was produced by these banks or bought by these banks in Q3 2019. That's 90 billion in Q3 this year. From a staffing perspective, how different does your staff look given that the volume is down this much, but more importantly, the units are down materially, right? We've had such tremendous housing appreciation over the last several years that, that same unit of origination isn't the same number of units that you're actually pushing through your origination or your manufacturing process. So you have a lot less units. Even though the decline in volume is shocking, the decline in units might be even more shocking as you looked at it. Can we go to the next slide? The expense side. So, I mean, short of reading anything about the election, the second thing that's probably in all your email feeds and anything you're looking at is all the expense reductions that are going on in the industry. So in the mortgage space, we're very much aware of the revenues and the revenue challenges, and we're very much aware of the expense challenges. And this is just a snippet of some of the headlines. But a couple of things I wanted to point out here. One, not everyone's cutting expenses or getting completely out of businesses. There are, as we've gone through both the Nashville MBA Nashville annual conference and the accounting and finance conference last week in Phoenix, there are companies, as there traditionally are, they're going to try to grow through this cycle. So while layoffs are occurring and some participants are actually, getting out of certain mortgage segments or channels altogether, there are others that are investing at this time. And so again, it really depends on the strategy of the company. But as in April, Planet acquired a whole correspondent unit, knowing that mortgage rates had already increased. And so not everything is always negative news here. There are a number of companies out there that are going to grow through this cycle through M&A, mergers and acquisitions, or acquiring talent. And so again, people are looking at their strategy, looking at their financials, looking at that benchmarking data and determining their kind of path forward through the cycle. If we go to the next slide, one of the areas I wanted to really highlight for folks in the industry, and if I am sitting down, but if I were standing up, I would definitely be on my soapbox at this point, and I'd be pointing at everyone on the phone call. We're really good at this industry of understanding our revenues. And we may be good about chasing new products or not chasing good new products and incurring expenses there, but we're pretty good about expense management. But I think one of the things that we really need to consider at this point in the cycle is where we are from a risk standpoint. What have you done with your IT staff reductions in terms of reducing the staff? How exposed to you are now cyber risk? We've got Michael coming up next to talk about a lot of the risks that are present in the mortgage space when it comes to cyber. I don't want to steal his thunder, but it's one thing to look at cutting those IT costs, but it's another thing to think about what risks are you now creating because you've cut your IT staff. In addition to cyber risk, what's happening to your business intelligence and reporting as you reduce those IT staffs? Do you have data to help run the business, run the ongoing business? And for a lot of companies, the answer is probably didn't realize we were creating all that risk, and I lose the ability to sort of track myself to the industry. So again, it's not saying that reductions were bad, but you need to sort of replace that potentially with an outsourcing solution, or at least acknowledge that you might be creating more risks. Within the operations and back office, right, where we're cutting underwriters, cutting QC, cutting this, what's the status of that underwriting or the ops team to actually charge and create new products for you that are going to be compliant, that are going to be saleable? It's this part in the cycle where all those oops loans, all those scratch and dent loans, all those repurchase loans that you've had over the last years, there's not much you could do with them because rates are so high, you can't refinance them. So again, are you creating undue risk here in terms of your operations or your quality? And then your support staff. Again, as we had Jennifer lead off the call today, right? Audits still need to get done, still need to fill out your MBFRF, still need to comply with your warehouse, still need to comply with all your other audit requirements out there. What does that function look like? And are you staffed appropriately to kind of get through that? So again, as we have taken costs out of the system and right-sized companies, have we created sort of risks that we're not necessarily thinking of? And I realize that's easy to say on my soapbox here because we're all trying to survive what's going to be probably a very terrible Q4 and a pretty bad Q1 next year. But let's not put ourselves in a risk that when that spread between the treasury rate and mortgage rate does collapse, that we've got the adequate staff, the adequate metrics, the adequate team to be able to sort of refi that latest production and next year hopefully have a very strong purchase season for the spring and summer months that we didn't have this year. We go to the next slide. And so quickly from some MSR trends before I turn it over to Michael, go to the next slide, Molly. This is 7 banks that I track, and you can see I've tracked them back to 2010. And on the good news front, their MSR valuations as a percent of their outstanding principal balance is at all-time highs. This shouldn't come as a surprise, given the fact that 2020 and 2021 production is at such low coupons compared to where rates were at quarter end, that MSR values are at all-time highs. Next slide. From that standpoint, this is the value change. And one thing I wanted to point out here, and it's present in the Richey May Select data. I'm sure it'll be present in the MBA quarterly reporting that they're going to come out with here shortly, is that impact of the value change of the MSR asset is having a decreasing impact on financials at this point. Servicing values are starting to tap out on that 3%, 3.5% coupon. There's not much value change left. So many companies were profitable in the first quarter or second quarter as a result of servicing write-ups or executing a servicing trade. That is more or less going away here as we enter, unfortunately, the winter months. So just something to be aware of, that those that retain servicing, they did benefit clearly in their overall financials. But as we kind of wind out the year, that value is not going to be as strong, or in some cases, it may actually come down a little bit on the most recent production. So I'm going to turn it over here. Oh, and one other piece, and I love this from Leonard Kiefer, and I think Marina from the MBA might be on this call, and she knows she's tired of me quoting Mike Frantantoni, who's my favorite economist of all time in the mortgage space, but Leonard Kiefer at Freddie Mac is my favorite visualization economist. And this is some great data that he produced a couple of weeks ago, showing just the lack of refinance incentive as mortgage rates were kind of approaching that 7% number. The average coupon on the outstanding mortgage stack was around 3.3%. So borrowers had, in essence, negative 350 basis points or more of rate incentive to refinance. Said another way, the next refinance cycle of 2021 and 20 magnitude is not in our near future, I don't believe. But production that we did create in 2022 at 6.5 or higher rates, or even 6% higher rates, if you look at the MBA forecast, they are projecting mortgage rates to be around 5.5% by the summer months of next year. And that's probably a very good purchase market, and quite frankly, a little bit of a refinance cycle for the originations from this year. So with that, I believe I'm going to turn it over to Michael, who's going to talk about some of the cybersecurity risks out there. Again, as we've highlighted, there's been such staff reductions. Michael, I'm laying it up on a platter for you here on the risks there, so I'll turn it over to you.
Michael, your audio is not coming through. I'm still not hearing it on my side.
How about now?
There we go. We're in business.
I feel like we tested this ahead of time. Can you hear me now?
Yep, it's good.
Perfect. Sorry about that. So right now we're going to touch on the cybersecurity attack trends that happened in Q3 and what we're looking at for Q4 and beyond. And so what we saw from a cybersecurity perspective through the industry is laid out here. Number one, social engineering is on the rise. We've seen a dramatic increase across all of our client base and throughout multiple industries. It's a pervasive issue, and it's a popular attack structure because it's effective. It's also the most common entry point, right? The largest attack surface of any organization is their human element. And there's not a technical solution that you can apply to humans to prevent them from giving away information. What we saw in last quarter's biggest attacks were Uber being attacked and having that initiate from a social engineering or a vishing call to an admin. Social engineering often leads to, or most commonly leads to, business email compromise, access to the internal emails, or malware attacks. And just another fancy way of, at this point, saying ransomware, because it's the most common type of malware attack. And as I stated, humans are that largest attack surface, and so social engineering is on the rise. We'll talk about later on during this portion of the presentation what to do about that. Wire fraud increased about 40% in Q2. Still waiting for Q3's numbers from the FBI and IC3.gov. Wire fraud typically getting caused by business email compromise or some form of phishing, but more pervasive and more commonly utilized attack inside of the mortgage industry, as well as funds are being wired a little bit more consistently across even the client base at this point. We are expecting to see an increase of wire fraud due to the market volatility, which we'll talk about in the next point here. But as you can see, in 2021, there were 552,000 reports of fraud and wire fraud to the FBI's Internet Crime Division. Moving on to the right sizing of the industry and just the market volatility, right? As Seth was pointing out, in downsizing, in layoffs, in whatever is happening throughout the industry, as we're making these tough decisions for our organizations, we have to understand what risks that can create, and a vulnerability or a risk is obviously created when an IT staff member, a cybersecurity staff member is let go, and that creates a knowledge loss, right? There's a tribal knowledge that person has, depending on how many years they've been there, and transitioning that knowledge to other team members or releasing a department in its entirety creates a massive vulnerability for an organization. Periodic tasks are lost. Checking up on common vulnerabilities and risks within an environment, making sure that security awareness training is continuously happening, not happening as often or at all anymore now that we've lost or had to make those difficult decisions. Cyber vigilance is also neglected, right? Across the organization, as we said, security awareness is not a focus at this point in time due to some of those decisions. We also have to consider what data is lost due to any form of downsizing, right? Where did data exist when somebody is no longer within the organization? What happens to that data? Is it in their personal computer? Did they have printouts? Did they have flash drives? Where does all that exist? And when there are immediate or sudden changes to an organization, organizational size, that data is often neglected or forgotten. And through all of this, through the changing organizational aspects, right, industry regulations are not being considered as well, right? Whether it's Privacy Act, CCPA, NYDFS, FFIEC, FTC is coming out with proposed safeguards as well. The focus on those is not continual in that, and there's also emerging privacy acts. Virginia and Colorado just recently passed theirs. They go into effect in 2023 that all have considerations for cybersecurity and how to protect individuals' information. What I will say is vulnerability creates opportunity. Cyber attackers tend to focus on the most vulnerable of industries, right? During COVID and the biggest hits to hospitals, cyber attackers were focused mainly on healthcare, trying to exploit an overworked industry in a time of crisis. And so as there are downturns in any industry, cyber attackers will focus their resources towards that because they know that there is risk and vulnerability that is going unattended, and they will try to exploit that. As for a last trend, it is cyber hacking season, and so Q4 is historically the most prevalent quarter for cyber attacks due to the reduced staff in general for vacations and holiday time. There's a lot of online shopping, therefore a lot of information traversing websites, people looking for the best deals and not necessarily paying attention to what's most important. And so as we enter into this season, constant vigilance is important. We'll move on and touch on just a couple of statistics. This is an annual perspective from January 2023 through to September of the amount of cyber attacks per month. I don't have the axes on here, but what you can see is there's just a trend moving up throughout the year of increased cyber attacks across every industry. We can see for just the last quarter, year over year, and you can see I have 4 years of data here, cyber attacks were relatively in alignment, right? But this year alone, we've seen an increase of about 30% from 2021 to 2022 for the last 3 months. And so there is a lot more focus and campaign from a malicious cyber attack perspective. A breakout of those types of attacks, what we'll focus on here are the large 3 here. So yellow being account takeover, that's business email compromise, that's password stealing. Malware attacks make up almost 50%, so 43% of the types of attacks, and that 32 is really other types of attacks or multiple attacks in one. So an account takeover and a malware attack pushed together. So you can see that the big focus is protecting your organization from malicious activity, malicious files, but also making sure that the human element is protected as well. And then this is some data from a company called checkpoint.com. They're a cybersecurity product company. They broke down the average weekly attacks per organization by industry, and you can see that in finance and banking there were about 1,139 attacks, which is a 40% increase year over year. I'll quickly state that while all of what I just said is daunting, there is a lot that can be done about it. And realistically, protecting your organization comes down to that human element. And the top 2 here focus on visibility, focus on what you can do inside of your organization to understand where your risks are, and then providing constant vigilance towards that. If you get an email, if you get a text message, if you get a phone call and something feels suspicious, it's always okay to ask somebody for help or ask a question around that. Because 99% of the time, if you get a phishing email and you ask, you will not move forward with that attack campaign. Do not stop the focus on education inside of your organization for cybersecurity. Cybersecurity is a responsibility of every individual in that organization. We all touch different types of data, and so we are all responsible for that data within our organization. And preparation and building resilience inside of an organization. IBM and the Ponemon Institute found that organizations that focus on preparation and actually test their abilities can save around 40% on the cost of a cyber attack. The cost of a cyber attack in 2021 was around $9.5 million, give or take a couple $100,000 in the US alone. And so saving 40% by being prepared on that and being able to respond appropriately is important. And then through what we are seeing, as Seth mentioned earlier, through the downsizing in the industry and organizations that are having to make these tough decisions, utilizing your trusted partners, outsourcing some of this is a way to make sure that your organization is protected and to the best possible perspective. So utilize your trusted partners through this difficult time. I'll go ahead and pass it over from, actually I have a poll question, so we'll go ahead and post that up right now. True or false, Q4 historically sees an increase in cyber attacks and is known as the hacking season. Looks like the question got cut off there. give you just a couple seconds to answer.
Just a reminder, if you are looking to get CPE from this webinar, you do need to answer this poll question. So be sure to get those answers. Give it 5 more seconds.
Alrighty, and we should see there. Hey, look at that, everybody got it correct. Very difficult question. Thank you for answering. I'll go ahead and pass it over to Jared for his portion.
All right, thank you, Michael. So last but not least, I'm going to touch on some tax trends that we've seen over the last maybe 3 or 4 months. As Seth mentioned, we've been at some conferences here over the last 2 or 3 weeks and had an opportunity to talk to several clients and others just about what they're seeing in the industry from a tax perspective. And so going to try and share some of those thoughts with you today. See if I have control here. I do, perfect. Let's go back here. So losses was obviously a big topic of discussion. Many of our clients are expecting to experience a net loss this year from their operations. The question is, will that loss result in a taxable loss? So maybe from a financial reporting perspective, you expect to be in a loss, but there, as you know, there are significant differences between how income is reported for financial reporting purposes and how it is reported for tax purposes. So what I've done here is just tried to outline a few things to consider when looking at whether or not you will actually be in a taxable loss position for the year. MSR sales. So as you may know, generally you have little or no basis in your MSRs from a tax perspective, even though you do from a book perspective. And so if you sold MSRs, you likely are going to result, that's likely going to result in a very large gain from a tax perspective, which would increase your taxable income. Derivative assets liabilities. So if those assets are decreasing year over year, you're likely reporting fair value losses on your financials, but those losses are not deductible for tax purposes. R&D expenses. Starting here in 2022, R&D expenses are required to be capitalized and are amortized over generally a 5-year period. So while historically we've been able to deduct those for both book and tax, you may be deducting those or expensing those from a book perspective, but we'll need to capitalize and amortize from a tax perspective starting in 22. Fixed asset sales and book depreciation. If you sold fixed assets, there's a good chance that you have little or no tax basis in those assets, and so you're going to probably recognize gain on those sales. And with book depreciation on older assets that you're claiming in the current year, most likely you had fully depreciated those assets in prior years and are not going to get the same depreciation from a tax perspective. Reserve increases, so loan loss reserves, allowance for doubtful accounts. If you have increases year over year in those accounts, that results in losses running through your books, but those losses are likely not deductible from a tax perspective. And then you've got permanent differences, so entertainment expenses, penalties, lobbying expenses. These items are not deductible from a tax perspective. Items that could potentially decrease taxable income, just to point those out on the flip side, MSR write-ups. So, if you have a fair value adjustment to your MSRs and you actually wrote them up year over year, that income is not reported from a tax perspective. Fixed asset purchases, we've got accelerated depreciation methods that we can use from a tax perspective. And so that likely will result in large depreciation or write-offs of fixed asset purchases in the current year. Certain prepaid expenses. So while from a book perspective, you may be capitalizing and amortizing your prepaids over a year or two or more, from a tax perspective, there are certain ones of those that we might be able to accelerate and deduct in the current year. And then PPP loan forgiveness is a big one. That's either last year or this year, where if that loan is forgiven, it's not taxable. And so it obviously, even though it may be reported as income on your financials, would not be reported for tax purposes. Another thing to keep in mind with respect to losses is the excess business loss rules. So these EBL rules came in with the Trump Act back in 2017. And what it basically says is that you have your net trade or business losses. So this is actually reported at the personal level or individual level for tax purposes. And you net all of your trade or business income and losses together. And if it's a net loss, that loss is going to be limited to $540,000 if you file a married filing joint return, or $270,000 for all other taxpayers. So even though you may have, maybe you had a $3 million loss from your mortgage company, and if that was all going to get reported on your personal return as a $3 million loss, and if you didn't have any other trade or business activities that you could use to offset that, that loss is going to be limited to $540,000. So if you've got wage income, if you've got investment income, or any other types of income that is not trade or business income that exceeds this $540,000, you are still going to be in a taxable income position. So just wanted to point that out. And then just a note here, any excess amount that is limited in the current year becomes an NOL that you can carry forward into future years. I also wanted to touch quickly on these net operating loss rules. So if you generated a loss in 2022, that loss cannot, again, this is at the individual level, that loss cannot be carried back, but they are carried forward indefinitely. But the other caveat is that when you utilize that loss in future years, you can only utilize it to offset 80% of the income. So if you carry that forward into 2023, and in 2023 you have income, you can only use this 2022 loss to offset 80% of that income. So again, you're going to be in a taxable position even if you have an NOL carry forward that would otherwise wipe out your income. Another big topic that we heard in talking to clients here recently has been MSR sales. So several of you and others have contemplated or actually engaged in an MSR sale this year. So I just wanted to quickly review these rules just so that you're thinking about them and the impact from a tax perspective of that bulk sale. So if you had originated mortgage servicing rights, there's these concepts of normal and excess servicing. Normal servicing being what does it take for me to actually provide the services as a servicer on this loan? And there's some safe harbor rates that are generally applied here. And so a vast majority of OMSRs result in normal servicing. And if you have normal servicing, then you are not recognizing an asset from a tax perspective. So even though on your financial statements, you put this asset on at fair value, from a tax perspective, your basis is zero to the extent that it represents normal servicing. If you have excess servicing, then there may be a component that you are also recognizing income and putting an asset on your books. But again, the vast majority of OMSRs results in normal servicing and there's no asset and therefore no basis from a tax perspective. If you had purchase mortgage servicing rights or PMSRs, these are capitalized at cost and they're either amortized over 9 or 15 years. So obviously you do have basis in those assets. But then the tax treatment upon a bulk sale, so generally when you're looking at OMSRs, which is the vast majority of the ones that you're probably retaining, there's three components to the bulk sale or the valuing of these upon a bulk sale. You have the compensatory portion, which you get ordinary income treatment on, and that is supposed to represent the portion of the value that is tied to the compensation you're receiving for providing the services. There's the excess servicing value to the extent you had excess servicing, and then there's goodwill. And if you've done these before, then you know that when these get valued, the compensatory portion and the excess servicing value tend to be quite small in that valuation, and that the goodwill value tends to be a vast majority of the value. In fact, in most cases, that goodwill value represents 90+% of the value. And so there's an opportunity here to get capital gains on a large portion of this bulk sale. The key is that you have to hold those MSRs for at least a year in order to get the preferential income tax rates. So, selling short-term stuff will result in a short-term capital gain. Short-term capital gains are taxed at ordinary rates. See, we're running out of time, so I'm just going to quickly fly through these last couple of slides. We've got tax legislation update, really not much to report here. The Inflation Reduction Act came in here in 2022. The biggest thing for most people on this call is probably that those excess business loss rules that I described a couple of slides ago were extended through 2028. So keep that in mind. Most of these other provisions really don't apply. The corporate alternative minimum tax only applies if you had $1 billion in financial statement income. The stock repurchases only apply if you're a publicly traded company. IRS funding, obviously that was a big thing that came out of this act, and that the IRS is getting some additional funding to try and engage in more audits. So you might see an uptick in audit activity. And then there's energy credits. The biggest ones that would apply to you would be the residential or clean vehicle. If you're buying that Tesla, there's charts and things that you can look at to see if you qualify for the credit. Several provisions from the TCJA Act are expiring starting in 2026. So just wanted you to keep that in mind. And then there's pass-through entity taxes, so state income taxes that are, that are being applied at the entity level. New states have adopted those here in 2022. I've listed those out. This was an attempt to try and get around the $10,000 cap on your personal return for state taxes that you can deduct by using, by applying or assessing the tax at the entity level. Future legislation, who knows? We obviously just got through the midterms. I don't think there's any expectation of significant legislation in the near future. And lastly, just a couple other quick trends here. We definitely expect an uptick in M&A activity here in Q4 and in the first half of 2023. And then compensation strategies. Again, I think, IMBs and others are moving away from those large sign-on bonuses and guarantees and are looking at other strategies to try and retain talent. So we're talking with clients about equity-based strategies and or deferred comp plans to try and help them with that. And so with those comments, I'll go ahead and turn the time back over to Nathan for any final comments he might have.
Great, thank you, Jared. It looks like actually we've got a poll question that we've got to tee up here real quick, sneak in before our time is up. So are you considering an MSR sale between now and the end of the year? Yes or no? And if you're hoping to get that done before the end of the year, hopefully that MSR sale is already underway. Getting it done that quick would be very challenging. I'm sure Seth would sell us.
Very, very challenging.
Yeah. So yeah, that question could probably be worded, do you have an MSR sale that is already in the works? You expect
starting from scratch right now with a holiday next week and the holidays in December, it will be very difficult to execute something between now and year end if you're not pretty far down the path. Like out in the market already.
With the average person working probably 10 days between now and the end of the year. All right, so we'll go ahead and look at the results there.
Got voted, and I still see a lot coming through, so now's the last chance.
Okay, we'll hang out for a sec.
It goes in quickly.
Okay. Well, that's probably about right. We could ask Seth what the MSR market looks like right now, but we're pretty much out of time, and I'm sure If I summed it up this way, I'm sure Seth wouldn't disagree that market is much more constrained and limited than it was in the earlier part of the year. So that the results of that poll are probably pretty representative of what we're seeing out there in the industry. So with that, we just want to thank you all again for joining us today. I know there was a lot of information shared there, and your days are consumed with negative news. The market is not great. We know that. Not saying anything that we don't all know, and we're not all living day in and day out. But I do just want to close and say that there are some glimmers of light at the end of the tunnel. As Seth mentioned, there have been some positive inflation numbers here over the last week or week and a half. If that continues to happen over the next couple of weeks, I'm quite sure that the market will improve pretty significantly. Money will pour into treasuries, yields will come down, and hopefully rates will be a little bit more reasonable next year. We can pick up some more purchase business and things will improve. But it is a challenging time, but keep your heads up. My mom used to say all the time, this too shall pass. It will pass. The earth is not careening out of control into the sun, and so the sun will come up tomorrow. But I know it will be a challenging few months here for you. So if there's anything that we can do to support you, as I mentioned at the beginning of the call, don't hesitate to reach out. We're here to support. We're here to answer questions. Do anything that we can to support you and your organizations. And hang in there, and best holiday wishes to all of you, and hope the rest of the year goes well. Thank you again for joining us today, and we'll sign off till next time. Take care, everybody.